I'm speaking today with Corey Rosenblum. You're watching the MoneyShow.com video network. Hey, Corey.
Hi, Karen.
Good to see you again.
Good to see you.
I want to talk with you about inter-market relationships. I know some traders get into a bubble and just look at one thing. Is that a good thing or not?
Not really. Unless you're an intraday trader, it's typically a good idea to look at cross-market currents or relationships and how they play out. Let's assume temporarily that a trader is an S&P trader, trades stocks, that's all he or she looks at. Well, currently we have a positive relationship with commodities. So stocks and commodities in general, especially gold and crude oil, move in the same direction as stocks. So if a person is looking at the S&P, maybe a daily or a weekly chart, and is seeing not much to go on, they're not seeing a whole lot of patterns, maybe they can look at the gold, crude oil, and then say, okay, well now I'm seeing a head and shoulders, any kind of technical pattern that they might have a better interpretation on. And so that's a little bit a way to do that. Contrapositively, the dollar currently is inversely related. So if they're seeing maybe a bullish pattern in stocks, they can confirm that bullish pattern with a bearish pattern of an opposite junction in, say, the dollar index, or maybe across maybe the Forex in terms of US dollar and the euro.
Well, what happens when those relationships get out of whack? For instance, the dollar strengthening now, which then makes dollar-denominated commodities much stronger as well. And that's generally not the case.
They do. Intermarket relationships, that's kind of the paradox about them. They last until they fall apart. So, and
like most relationships.
Like most, well, there you go, like most relationships, exactly. And what we're looking for with the dollar is well, I guess in some senses it's a carry trade. So with interest rates currently low, really about almost 0%, a little
right.
bit in that zone, it's easy to borrow, or in some cases short the dollar. Say a hedge fund would do this, large funds would short or borrow dollars and then turn right around and buy commodities. So interestingly enough, that's going to drive the price of commodities higher. But if the relationship breaks down, or the opposite happens, the dollar begins to strengthen, they're going to have to cover their short positions, in which case they would have to unwind. They would unwind the carry trade with commodities, gold, whatever they're using to finance. They'll have to come out of that position, driving it lower, the dollar higher. That may not be the case in the future. It looks to be right now, but we don't know how long it's going to last.
And what do you watch when you're looking at these intermarket relationships?
I look at daily and weekly charts. Any kind of software program, any kind of charting platform, mainly looking at moving averages. So starting with trend, I want to look first at the trend, our uptrend, downtrend, neutral trend, and to compare these across the markets. Then we turn to other volume, maybe what is the participation of the traders? Is volume increasing as price is rising? That's bullish. If not, that's bearish. So then we'll assess strength of trend, looking also at momentum. So comparing these cross markets and trying to find junctures where they align. If they're in alignment, that gives confidence for a more successful trade. If not, we may have to reduce risk, not play with a larger position as we would not like to, and be more conservative.
Corey, thanks for coming in today.
Thanks, Karen.
My guest has been Corey Rosenblum. You're watching the MoneyShow.com video network.